Welcome to you both. And Jay, I'd love your take on where you think we sit with the underlying economy. You look at things like manufacturing. The ISM indicator today was in contraction mode. Housing obviously is hurting, and yet incomes, jobs, consumer spending on services seems okay. How does that net out to you?
Yeah, so Mike, net, I mean, it seems like the economy continues to expand right now, probably at a below trend pace. I mean, we're talking maybe 1.5%, but it's not in negative territory just yet. But I mean, I guess the thing that I worry about is you still have a bunch of Fed previous tightening that's already in the pipeline and probably more coming, as Chair Powell indicated yesterday.
Yes, in fact, almost certainly more coming, but I guess the key question is how much more? And did Chair Powell, Jay, suggest that there's just a little bit more of a balanced approach right here and waiting, in fact, for those lagged effects of what the Fed's already done to show up and respond accordingly?
Well, the thing, Mike, that got all the headlines yesterday was his reference to, we're going to back it off to 50 in December. But, what he also said is a big question is how much further do they have to go? The market's priced for another 50 basis points after this one. I think it's going to be a little bit higher than that. And then he also said that, okay, it's not like we're going to start easing right away. We've got to keep rates restrictive territory until we're sure that inflation comes down. So right now the economy is doing pretty well, but how's it going to be 6 months from now with rates even higher and probably on hold for quite some time? I think that's the big question, and that's where we still are a little bit skeptical.
Gotcha. And Katerina, in terms of how the markets are, trying to process all these things, we've seen another very good rally off of a low, at least some suggestion in there that the seasonal forces continue to be pretty strong as tailwinds, and maybe the market's priced in some muted expectations for earnings next year. Where do you think the probabilities sit?
Well, Mike, we will take any kind of rally. And in our view, it's a tactical rally that most likely is going to continue throughout the year end. And I agree with Jay. We most likely are going to see another rate hike in December, maybe one in January. And this is what this year was all about. We watched Fed action. We watched inflation. But 23 is going to be defined by two stories. One, whether we get the economic recession or not. And hopefully short and shallow, but we don't know that yet what kind of recession it's going to be and whether we're going to get one. And two is earnings revisions. And some of those revisions might take investors by surprise and result in another significant downside before we can comfortably call the end of this bear market. But on the other side, they're going to reflect the actual state of the market, which is very healthy for us and very healthy for the economy and will allow us to move on to the next cycle. So in our view, investors should know that and expect this and be prepared to still stay defensive and stay with sectors like healthcare, like financials and industrial, focus on dividend-paying stocks, and find some safe haven in bonds. I mean, it's good that we can finally generate some real yields on the bond side, especially if we stay short-term, with high-quality fixed income. This is also a great opportunity to increase the overall quality of the portfolios by finding some strategic buying opportunities. We have to be very tactical. This is definitely a stock picker's market, but there might be some volatility and additional pain before things get significantly better in 2023.